Dustin with Dustin's Dollars. Today I'm going to be talking about Venture Global LNG, ticker symbol VG. I'm going to be walking through, so I'll give a super brief overview of the company for anybody who's not familiar. I'm going to walk through the investor presentation after the third quarter earnings just a little bit, and then I'm going to go through my updated valuation model that I have for the company. If you've seen this on my channel before, it is similar to what I've done in the past, although I've incorporated a fair bit more detail into that. And I'm going to be talking a little about why the stock has been dropping. Before I begin, at least why I think it's been dropping. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Venture Global, so this video should be for your entertainment purposes only, because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. So, Venture Global, here's this brief overview of the company if you're not familiar. Venture Global LNG is an LNG exporter. They're based in the United States, down in, I believe, Louisiana, and they purchased natural gas. They pipe it in through pipeline, they liquefy it, so it turns from just natural gas into liquefied natural gas, and then they sell it to folks who want that liquefied natural gas. And Venture Global has two operating facilities, and then one is the Calcasieu Pass facility is currently sort of in full operations, more or less. It's reached its date of its commercial operations date, and they are, oh, hi folks, I got some folks on the stream. I'll get to your question in just a minute. I'm going to get through the overview of the company real quick. So they have the Calcasieu Pass facility that is already up and running and have all of most of the LNG that is being produced there sold under long-term sales and purchase agreements, sort of at fixed fee rates. So Venture Global, on most of the volumes that they have sold under these sales and purchase agreements, they do not have any risk in terms of the underlying natural gas price that they have to, they have to acquire the natural gas in order to liquefy it and then export. They pass that cost directly on to the customers, and Venture Global just gets a fixed fee in the middle, more or less, in terms of this is what our profit is going to be. And usually you see those contracts denoted in terms of the underlying commodity, the Henry Hub gas, plus the price of that, plus an additional 15% to cover the gas that is consumed and most of the expenses at the actual of doing the liquefaction. And then there's a fixed fee on top of that that is usually denoted in terms of MMBTU, and that's for Venture Global, for Calcasieu Pass, somewhere around $2 per MMBTU. So then you can multiply out how much they actually produce and export, and then you can look at that was their sort of, you call it roughly like their gross profit for the company. So they have the Calcasieu Pass facility that is up and running and fully handed off and exporting gas under those long-term sales and purchase agreements. They have the Plaquemines facility that is currently in commissioning, is producing quite a bit of LNG, but as those long-term sales and purchase agreements have not yet kicked in. And then they have the CP2 facility, where that one is split into two phases, phase 1 and phase 2, and that one they've just reached their positive final investment decisions on the phase 1 of CP2 earlier this year. You can see it was in, I guess, July, and then they are working on that for phase 2. I think they expect that sometime next year. They probably have it if I go to the CP2 section. So, all right, I have a couple questions. I'm going to go and answer some of those, since it sounds like folks are on topic here and have some existing knowledge of Venture Global, so I don't want to make you all wait. So Mr. Ron Mexico XXX asks, why not wait till after all the lawsuits are resolved, then buy and hold? Dustin, thanks for the videos. Yeah, so I'll talk about the lawsuits near the end of my valuation, because the way I value this company is that's just a one-time cost. It's just going to subtract right off of there. Basically, whatever valuation model, however I would value the company, ignoring the lawsuits, I just do that full process and then just subtract off some number for what that might be, right? It's kind of like a one-time payout, as far as, at least that's the way that I model it. That may be totally wrong, or you may think that's not the right way. And I know the company, because of accounting rules, is actually reporting less revenue on a quarterly basis for the Calcasieu Pass. It's sort of this weird thing that I didn't really want to go in too deep today in terms of how they're managing the accounting for that, because it's weird, and to be honest, I don't really understand why they are even doing it that way. But um, the short answer is I actually think the lawsuits are pretty limited in scope. I mean, the numbers aren't tiny, right? It could be billions of dollars of damages, but I am willing to take that risk. And I think absolute worst case on the topic of the lawsuits, if you look at the way that they have this entire company structured, I'm going to go down to a slide 25 in their investor presentation. They have different LLCs for this company. And if you notice, they have Calcasieu Pass, right? All the lawsuits, as far as I understand, are for Calcasieu Pass because that's the actual project. They have limited liability corps around that particular company and that particular facility. And I think, and this is a point I've heard other folks make. A shout out to, I'll say, Chris Patel and Matt Money on the Cash Flow Chronicles, one of my favorite shows on YouTube, probably my favorite. But they talk about Venture Global from time to time, and Chris made the point, and this is something I already thought about, and I agree 100%, that worst case, they could default basically at the Calcasieu Pass company level and just hand over that facility to, I don't know, the debt holders or the, because I don't know how that exactly works with the lawsuit awards, but if it ended up being too bad, they could do that. And as far as I understand, Venture Global would still continue to have the Plaquemines facility, the CP2 facility, and their midstream assets, the pipeline that comes into their facilities. And that, I think, it wouldn't be good for the company, don't get me wrong, but Calcasieu Pass is their smallest facility by far. We can see that when we go through some of the numbers. In fact, that gets me into sort of the current state of the company. If you look at their highlights, their current ramp up, you can see right here. Maybe I'll zoom in just momentarily to see this graph. This bar graph is on a quarter by quarter basis. How many cargoes the company has exported, and these dark blue bars are from Calcasieu Pass. The lighter blue bars are the Plaquemines, and you can see the Plaquemines is still ramping up, but already this facility, the Plaquemines facility, is producing more than Calcasieu Pass, probably about double what Calcasieu Pass is, and I think at peak it's going to be more than double what the capacity of Calcasieu Pass is, right? Because the Plaquemines facility is still ramping up, if I recall correctly, and the CP2 facility is roughly the same size as the Plaquemines, and so again, of course, it would not be good for the company if they had a default on the Calcasieu Pass facility, but it wouldn't totally destroy this company. So I still think the damages for this are low single-digit billions of dollars. There's a chance that this maybe even gets reversed, right? I mean, I don't know. I don't understand it all. I'm not a lawyer, but I think that there's still a chance that it could even go the other direction and have either de minimis damages or nothing. Maybe somebody reinterprets their reading of the contract. So I think I personally think it's overblown in terms of a risk to the company. If you believe, yeah, that's sort of my general opinion. So hopefully that answered your question of why not wait till after all the lawsuits are resolved. I just don't think the lawsuits are the end of the world for this company. And then I'll go through some numbers once I get to my valuation model. So, all right, let's see. I have some comments from ACAR3044. Dustin, you should have an update on Delfin LNG. I did do a video on that 3 years ago. I'll give you just, it's off topic for this one, but I'll address this just real quick. Delfin LNG owns TGLO, but TGLO still 3 years later, and this is my concern with it, still does not give you any ownership in Delfin LNG. So who knows what they're going to do with that company? Yes, I think maybe eventually they might reverse merge, and TGLO might convert into shares of Delfin LNG. But I personally think it's really, really, really risky, because even if that's the case, we have no idea what ownership those shares of TGLO is going to translate into in Delfin LNG. So that's my 30 seconds thoughts on that. I know Delphin LNG has made some progress, but I just investing in TJLO makes me personally very, very, very nervous, and I hate to go in too much detail right now. I think I laid out those concerns in my video 3 years ago, and to my knowledge, nothing has changed. If and when that does, and we have some idea of what TGLO is actually going to translate into in terms of ownership for Delphin, I will definitely give an update on that company. All right, and AeroVR2973 says, "Hey, great to see you on. Also, VG just hit 500 cargoes. Yep, they are obviously, you can see they're ramping up here. And last comment before I continue going on with my material. Essence of Bitcoin says, Shell arbitration repeal is a nothing burger. Arbitrations very rarely get overturned. Yeah. Again, I just think the lawsuit risk at this point is overblown. I think the bigger concern with the valuation of the company, I'm going to get to this once I get to my model in a couple minutes, is just forward LNG prices. So anyways, hopefully that gave you an overview of the company and addressed some of the comments so far. Feel free, more comments. I love it. I love the discussion that we get going on here. Zoom out a little bit so you can see. Again, just an update on CP2. This is the facility that has just hit FID earlier this year, and so they will be constructing this. They are working on it. And I think first LNG for this might be expected in let's see, do they have a timeline? I can't see. Anyways, based on the fact that they're actually starting now, maybe late next year, early 2027, for the CP2 project, it might be in this presentation somewhere, and I can't remember off the top of my head exactly what it would be. I know that they've given some guidance on this in the past, but it is under construction and is going to be a very large facility. I think 20 billion tons per year in terms of nameplate capacity. I think peak production is going to be above nameplate. They expect about roughly 28, maybe it's 27 point something, but million tons per year, so it's a large facility. Roughly the same size as a Plaquemines facility, which I have been very impressed by the fact that they've been able to ramp this up, and by basically this quarter, Q4 2025, they expect to basically be at full run rate of peak production capacity, which is super, super impressive because that was a very fast timeline, and they're going to have a good full year basically at peak capacity before they actually hand this off onto their long-term sales and purchase agreements. And so, what they're able to get from this at, $6.79 per MMBtu, that's what they got in Q3. I think they dropped their guidance for what they expect going forward on this. So we'll see what they're able to get. I don't know what they have. Here we go. 84% of potential Q4 cargoes are actually under, a fixed liquefaction fee of $6.41 per MMBtu. As we're going to see in just a moment, that's actually a pretty good spread given the current market prices. And so AeroVR 2973 says it's done with the dirt work. They have modules coming before the end of the year. Foundations have started. I assume that's for the CP2. And yeah, they talked about this a couple quarters ago, I think, where they said, hey, we've already ordered the liquefaction trains. They're going to be delivered. I don't remember when it was. They may be even delivered now. Or I guess you're saying they have the modules coming before the end of the year, and that's it just such fast progress. And I think they're really, really front running this as much as possible. And I think they saw, if you look, just going back down to these the loans that they have, they've already got some loans for CP2 at the end of this quarter, and they had this this equity bridge facility, right? And I think I don't know for sure, but I think they got that debt in order to be able to pre-order all of those, either pre-order or repay the Venture Global level in order to be able to order those trains early on to produce LNG sooner. And I guess I'll just go and talk about this real quick. That's the valuation. That's not what I want to go to right now. What I want to talk about is the forward LNG prices. And I guess they have some of this in their investor presentation. Sorry for jumping around so much. They do have a slide on this where they talk about the LNG market overall. Where is this at? I know I can find it right here. And this was as of the publishing of their Q3 earnings, right? I think if you go in the footnotes, it's as of November 4th, right? So this is 3 to 4 weeks ago, and you can see they're looking out about 2 to 3 years, and they say, hey, there's a pretty healthy spread here, even at the end of this curve. For JKM, it's $9. For Henry Hub, it's 363. Subtract off, let's say, $2 per MMBTU for a shipping cost. Make the numbers a little simpler. It's called $7. JKM after shipping costs, and 7 minus 363. That's like a $3.40 margin per MMBTU. That's pretty healthy. However, that margin at the end of this curve, and even near the beginning, if you go from 11 down to above 4, you say that's roughly a $5 margin, right? So this starts at 5, it compresses down to 3.5 as of middle of 2028. That is a far cry from what they've been able to get so far, right? So these EBITDA numbers that we've been able to see, and again, going back to the Plaquemines update, wherever that was at, right here. Right here, where they're in Q4 they're getting $6.41 on that margin. That's huge. The underdog investor lawyer here. Arbitrations are almost never overturned, which is why businesses use them instead of court. That makes sense. Again, I am I'm not a lawyer. Sometimes I will try to look into things to try to kind of get a common sense guess at how things might play out. But yeah, that it's good to hear from you. So yeah, I think that's really, it's really good that one at least is closed, right? And it still baffles me. I don't understand. I'm not a lawyer. I do not understand. Maybe you could give some insight into how one of these arbitrations ruled one way and one of them ruled another. That is what really doesn't make sense to me, because I after the first one, after the Shell one was closed, I thought, hey, it's probably smooth sailing after this. All the rest of these arbitrations are not going to make a difference, and clearly, I don't know, maybe there were differences in the contracts themselves. I don't think they're public for us to look at. Maybe they're public as part of some case somewhere nowadays. I really don't know, but that's been a bit of a mystery for me. Anyways, what I was getting at when I was talking about these forward curves is they've been able to get $6, but now I pulled the updated numbers from CME Group. You can go and look at what their futures are priced at on a monthly basis, and I charted this out. So this line shows starting in 2026 and going all the way through to, I believe, the end of 2031 is what they had data for, maybe the end of 2030. That's what's charted. I think I have data through the end of 2031. But the point here is that, and I think that the numbers get a little bit less meaningful the further out in the future you go. Not that many, there aren't quite as many people trading futures for 2031 as there are for 2026, because there's a lot more people who care about getting gas in the short term. But regardless, you can see the trend here is very much that the spreads are dropping, right? That's a very obvious, almost linear line down as time is going on, where it starts out, and you can see the beginning of 2026 we still see the spreads above. And again, the actual spreads, I subtracted off $2 from shipping costs just so we have a rough idea of what might Venture Global be able to realize, because somebody has to pay the shipping costs, whether regardless of which side it's on, somebody's paying it. It costs roughly $2 per MMBTU. I mean, that's a very, very rough estimate, but that's how I have incorporated it in here. But you can see this in early 2026 is around $4. If you would go just eyeballing an average for 2026, that looks like maybe $3.50, $3.75. 2027 looks more like $3.50. 2028 closer down to the low threes, maybe even $3. I mean, a little above $3, maybe $3.25, and then it goes down and down and down. And so when I look at this I think is what the market is really seeing, and why we've seen Venture Global stock drop recently. Because I even pulled up just one particular month, because if you look at, I'm just going to compare on mine in March of 2026, my spread is about $4, which actually, if you subtract off the shipping, that would be a $6 spread. But if you look at Venture Global's data as they published it just a couple weeks ago, you can see the March spread here. JKM was about 11, and this March was about $4. That's like a $7 spread, and mine is 6. It's been 3 weeks, and you say maybe my data is wrong, but actually, if you look at the chart, this is the chart just for the JKM, the price of JKM for March 2026, right? If you want to purchase, I can't remember how many MMBTUs this represents, but a certain quantity of, I guess it's a million MMBTUs, a certain quantity of whatever the standard fixed amount is of LNG at the JKM location, and in March of 2026. And you can see that the price for this since roughly June of this year has been just trending down and down and down. You can even see since the November 4th was right here where it was $10 and what's that, $10.89 roughly, and right now it's at $9.98. So it's dropped almost 10% in a month. That's not to say it can't come right back up shortly. These things, obviously you can see there are spikes up and down. There's some volatility here, but that's also a big move, right? 10% in 3 or 4 weeks. So that is also being reflected in the stock, because that really just is less and less margin that Venture Global is going to get in the future. All right, a couple questions in the chat that I'm going to go through before I walk through my valuation model. How many shares? Sorry, and I'm not going to attempt to pronounce your name because I think I'm going to get it very, very wrong. But this viewer asks, how many shares do you think should be owned to be a millionaire by 2035? That's a good question. I mean, basically, to look all the way out to 2035, you are, and I'm going to get into this, you're making a bet on sort of, number one, the management team of Venture Global continuing to execute, and I think they do have a track record here where if we extrapolate out in the future, we can say they've done a good job. That's my opinion. I think they've done a good job producing, or getting the facilities up and running, managing everything, keeping their costs in line. They've done a good job of those things. But then the second piece, and this is huge, and this is what I was just talking about, is you're also making a bet on commodity pricing. Venture Global actually has quite a bit of their capacity, and this is really exacerbated with the Plaquemines and with the CP2 facility, a large portion of their capacity that is uncontracted. Traditionally, a lot of facilities in the LNG space, US LNG, were contracting 80 to 90% of their volumes, and they had a little bit that maybe they sold in the spot market under short-term agreements, but the very, very large majority, again, like 80 or 90% of their volumes that they produce, were sold under these fixed fee 20-year contracts. But Venture Global, again, their business model is interesting, but they rely on the spot markets much more, and that's both during the commissioning phase, where they produce a lot higher volumes, because they're able to produce earlier on in the lifetime of actually building their facilities, and so they have a longer time span when they're actually producing and exporting LNG, their commissioning cargoes, and so all of that is sold at spot prices. And then even once they actually reach their commercial operations date, and all of those long-term sales and purchase agreements kick in, and a good portion of their volumes are actually sold under those contracts at fixed fees, Venture Global is able to produce well above their sort of nameplate capacity. And for the Plaquemines facility and for CP2, they're expecting, and Plaquemines are actually demonstrating right now, the ability to produce 40% higher volumes than what the nameplate capacity of their equipment is. And so that's an additional 40% of production that they are now selling at either short-term or spot rates. And because of that, they are very, very exposed to how do LNG prices, change. And so I'm not going to give you a straight answer, but I just want to say, I mean, I could probably tell you once I get down here, but the point is that they have a pretty large portion of their production that is not contracted and is going to be very, very volatile. So looking all the way out to 2035, like, they don't even have JKM futures out past 2031 as far as I can tell. And so looking all the way out to 2035 is pretty tough. I think you have to really have a view on that in order to answer your question. So All right, I do have some very, very relevant comments here. I see Essence of Bitcoin says, based on what I checked from forward curve, spreads compressed to around $2 per MMBTU till 2030 to 2031 and then increase after that. Um, I don't think they have. Let me know where I could find JKM futures if they're publicly available. I don't know that I have access to anything paid for JKM out past 2031. I'd be very, very curious to see what those look like. I would believe that, right? Because I think there's been a lot of modeling out in terms of all these facilities, and people start to sort of they don't know what the export capacity is going to be post 2031 because that's roughly how long it takes in order to build all these facilities, and after that, who knows what's going to get FID'd in 2026, 2027, 2028, which is what you really need in order to have a good forecast for 2032 and beyond. And Essence of Bitcoin also says spot market reliance is going to decrease once more and more SPAs are signed and they are getting orders from customers across the globe hand over fist. And that I agree with, and that goes back to sort of my point about you have to trust management. It's really hard to and I do have some models here where I've made a lot of assumptions that management is going to do that. So let me walk through my valuation model, and I'll try to touch on that as I go through here. So if you've seen this before, and by the way, you can open this up. I should have this linked in the description of the video. If you have issues opening that up, let me know, but it should be there. You should have view access to this. And if you want to make your own, change some of the numbers here, you can just make a copy, and you got to be able to make a copy in Google Sheets as long as you have a Google account, and then you can change whatever you want to your heart's content, but the base one is view only. So I've modeled out each facility individually. So we have the Calcasieu Pass facility, Plaquemines facility, and CP2. Now I have modeled these out on a yearly basis, all the way going to, I've looked at the cash flows, all the way out to 2060. And I look at nothing past that, and that's a really, really long time. They don't actually have sales and purchase agreements out that far. That's my way of kind of looking out and assuming they're going to be able to continue selling even past the current 20-year SPAs, and to give enough of a time frame to where I can look at those likely future cash flows and then ignore what the terminal value of the company might be. Because if you're able to just model out cash flows at a decent rate far enough into the future, the terminal value of the company at that point starts to be closer to a rounding error because you're discounting it so much on your discounted cash flow valuation. And that's sort of the way that I prefer to do things. Again, not a financial professional. It's what kind of makes intuitive sense to me. So if you think that's dumb, wrong, feel free to ignore the way I have things here. And again, you can access the sheet yourself and change the assumptions, change the model to your heart's content. But I've modeled this out. Excuse me, I need a quick drink. Sorry about that. And I have separated out each facility in terms of their production that they do for commissioning, the production that they do post-commercial operations date that would actually be sort of at their nameplate, and what is excess. And I sorry, this is a carryover from a prior model. I probably should have deleted some of these rows, and I just didn't clean that up as I was doing this. But basically I have what production is sold at, really it should be what production is sold at long-term pricing under their sales and purchase agreements, what is sold at short-term pricing under their sort of spot or very, very short-term agreements. And that is all multiplied out here by what I think the margins are going to be. And for the base margins for their sales and purchase agreements that they have, I use roughly, just under $2 because this is what they reported for Q4, and I kind of like went forward and give it a slight increase for inflation year over year. It's 2.5% on 17% of that fixed liquefaction fee, which is what the company has sort of roughly stated they do. And then I have rough numbers for the short-term pricing margins that I kind of picked off of this chart here. And it kind of goes down from $350 for the next couple of years down to $250 into 2030. If you look at this as about $250 in the 2030s or 2030, and then I just kept it at $250 for now, so that we can get a valuation to see what does a valuation company look like if we keep those numbers. And again, we can up it or raise it or lower it a bit at the end to sort of see what does that do to the valuation of the company. But that's what I'm using right now. And I use similar numbers for Plaquemines. I have the Plaquemines facility using a fixed liquefaction fee of $2.20 and increasing for inflation. Then I have the CP2 facility doing a 230 and increasing for inflation post commercial operations date. I also modeled in because the expansions at the Plaquemines facility and the CP2 facility. And just to be clear, they do not have enough sales and purchase agreements signed for these. They haven't FID'd these projects, but I'm modeling out some expansion because with the way this company has been expanding, it's obvious that it's their goal to continue. It's obvious that management has the ability to continue as long as the market doesn't totally collapse and they're still able to sign these agreements. And I do think that Venture Global will be able to because they are a low cost producer, right? This is a commodity. They are a low cost producer. And, I don't love that they're signing these at, 230, 220. But on the flip side, that is why, and in my opinion, that's why they're able to just continue signing these deals even as people are having lots of concerns and saying, hey, is there going to be some sort of a supply glut? Is this actually going to be unprofitable for folks to buy gas in the U.S. and liquefy it and export? Venture Global is able to say, hey, we're a low-cost producer. Our fixed fees on top of the Henry Hub is low, so they're able to go out and sign deals, and they have demonstrated that. So I'm modeling this in. Again, you may think that that's wrong. You may not want to give them credit for the expansion that CP2 and the Plaquemines, because that's quite a bit. That almost is double from what they currently have in terms of FID. Right, the Plaquemines expansion I think is another. I don't know the numbers here. I guess I should look at it. 24 MTPA, maybe a tad bit more. The CP2 expansion that they had contemplated is another roughly 20 MTPA. It's a lot. I'm giving them credit for a lot in the future. However, I'm not assuming any massive increases in price. I think they're going to continue signing these low-cost sales and purchase agreements. That's what the market is going to, be willing to sign, and Venture Global is willing to give it to them. Other projects do not quite have the scale, do not quite have the cost management in terms of, how Venture Global has been able to construct their facilities and recoup some costs during commissioning. And this is what I'm modeling out here. On the flip side, I am not giving them credit for CP3 or Delta, which are two additional facilities that they have. I think they have the sites for, and they have, they've said, hey, we have a rough plan to do these eventually, but I think they're going to probably do these expansions first because the economics are going to be better on those, and maybe they'll wait and see, 2, 3, 4 years in the future. This is already quite a bit of growth, but if they're looking at 2028, 2029, they'll have a better idea of what is the market going to look like in 2032, 2033, right, in terms of supply and demand for LNG and also supply and demand for Henry Hub gas. So that's what I'm modeling out here. I'm not going to go through every single row here. You can open it up, but I have each facility modeled out. I also looked at the debt that they have at each facility level. You have the interest expense at the project level, and I keep that flat for the entire lifetime of these facilities. In this one, I'm not ever assuming they pay it off. I'm assuming they just refinance at exactly the same interest rate, so it just keeps my model simple. Obviously, that's not quite realistic, but that's how I have it modeled out here. One also thing to note is that Venture Global only owns 77% of Calcasieu Pass. They had some preferred equity that got converted, and it gives, Stone Peak, I think, Investment Partners. I don't recall the exact name. Maybe that might be wrong. But there's another company that actually owns a portion of the Calcasieu Pass facility. For the Plaquemines facility, I also modeled out the interest expense. Of course, in addition to operating expenses and G&A, I assume that operating expense just goes up with inflation generally, and G&A does as well. CP2, I modeled out all the same things. I sort of assumed that they're going to get similar interest rates for all their debt on CP2 as they did for the Plaquemines. And then, so I add that all up, and I get a rough number for cash flow after subtracting out the corporate G&A and the corporate development expenses they're going to have over the next couple of years. And then I go to the total debt that they have at the Venture Global level. And I do think they're going to have to take on more debt at the Venture Global level if they expand at the rate that I have them going here, just because their cash flows are not going to support all of the equity contributions that they're going to need to do into these expansion projects. And we've seen them do that in the past. And my estimate here is that over the next 4 years, they're going to take on an additional $24 billion of debt. But again, that's going to let them basically get to the point where by 2031 or 2032, they're going to be doubling their production capacity with the expansions at the CP2 facility and the Plaquemines facility. I also modeled in their actual capex here, which again, a lot of this debt I think is going to be issued in order for them to then fund a good portion of this capex. The timing of this capex might be quite a little bit wrong, but I think the amounts are pretty close in the vicinity. I just modeled off of recent project costs and assumed 60% debt, 40% equity. And then I also put in their LNG shippers, the tankers that they have here. And then this is not a big impact to the company, so I didn't spend a lot of time on it. I just sort of modeled it out in terms of how many ships are they going to have, what's their operating income for those ships, and then I just kind of kept it static there and increased for inflation over time. I did not do any detailed analysis here. My general comment on my commentary on the shipping segment is that it's a nice small hedge in terms of if they have, if LNG shipping rates go through the roof, they're going to be able to capitalize on some of that, and they do have the actual control in order to have their own ships where if they have issues with something and there's, some unforeseen circumstance or emergency, they have full control of these ships and they can, do whatever is right for their customers or whatever is most profitable, depending on what the needs of the day are. As of right now, I again didn't spend a lot of time because it's just a small amount in terms of the overall company because they don't have that many ships in relation to how much LNG they can produce and in fact will start producing over the next couple of years as some of these facilities really ramp up. All right, going through all of that, then I have a rough model for free cash flow. I subtract off an estimate for their overall interest expense, which again grows as I think they're going to be borrowing more money. As I said, $24 billion over the next 4 years. And so their interest expense at the actual Venture Global level will increase if they do that from, about $1.5 billion per year to, $3.3 billion per year. But then, you subtract off all of that, subtract off their capex, and we get what is their free cash flow per year. Then I modeled out their cash every year, starting cash, what was their free cash flow, what were their proceeds from issuing debt. Then we get to what is their ending cash for the year. Oh, and I must have made a mistake somewhere. I'm not sure why these are negative. I thought I fixed all this. Well, maybe they'll need a little bit more debt. Sorry, and that's a... Am I looking at an old version of my model? I don't think so. It's definitely the newer one. I must have messed something up at the end. I apologize for that. You know what? I can actually change it on the fly. Let's just assume they have to issue a little bit more debt to net this out. Say positive. This is not, I'm sort of stick my finger in the air and making a super rough estimate just to keep them solvent year after year. So that would be a little bit more debt. And I know this is this is horrible modeling. I could probably spend a lot more time. Let's see, does this keep them solvent? Generally, yeah, I guess they go negative in 2030. Let's say they borrow a little bit more. Again, these are not a great way to do things, but it does keep them, it's because these are unknowns. We don't know how they're actually going to finance these things. But this is a model. This is one possible way they could do it. When you built enough of these, you sort of see that the timing of some of this stuff doesn't end up being significant. Things like the actual market price of LNG is going to end up being way, way, way more important for the real valuation of the company over time versus what I have here. So anyways, when I go through all of that, and of course it changed my end number here, so the model is a little bit off, but when I go through all of that and I put a 10% discount rate on all of this, and I assume these, what I believe are fairly pessimistic numbers, you do get to an intrinsic valuation for the company of, $5.84 per share, which I know is very, very disappointing because that is beneath the current numbers, beneath the current market price. And if you want to put in a discount for the arbitration rate, if you want to subtract something off, say this is $3 billion, You put $2 billion. I think it's probably in the vicinity of what might be a maximum amount. I think $2 billion was my when I looked at it and tried to come up with a number, my rough max amount they could lose. Um, it's been a bit since I looked at that, but that would get you to like a current intrinsic value, sort of super base case for the company of $5.10 per share. Now, that is assuming that the current, I would say fairly, the current drop, again, 10% just in the past month in terms of future prices for LNG stick. But if this changes even a bit, let's say instead of longer term it being 250, it's actually not 30, $3 per MMBTU. The valuation of the company is, roughly in line with where it's at today. Around 750, maybe closer to $7 if you want to subtract off just a discount for the arbitration. And again, I'm also being fairly conservative in terms of what they get for the next couple years, right? I'm assuming even in 2026 they're only getting 350. If I look at my actual chart here, I think it probably will be higher than that. Well, certainly will be higher than that. Maybe I'm already being pessimistic here. If I even just change this to 375, it probably makes a small difference. Excuse me. And it didn't make any difference. Something's off there. Huh. Funny. I apologize for that. I wonder if I have maybe an off by one error. That changed. No, it did change. It just wasn't a big enough amount to change the... This is why, because I have no free cash flow from those years. Never mind. I can explain that very well. What it ends up doing is it ends up bringing in free cash flow to the firm sooner. Because if you look at my model, and this is realistic, right? There is no actual... In my discounted cash flow valuation, there is no cash flow, no positive cash flow coming to the common shareholder until they basically stop expanding. They start reaping the benefits of all of this expansion. What it did when I actually changed from 375 or from 350 to 375 for 2026 is it meant that the cash flows in 2031 are now more positive than they previously were, because sort of along the way the company ended up needing to retain more cash. Let me just put it that way. So that does all make sense. It wasn't a bug in my model. As I said, the future LNG price is the number one factor that's going to really make a big difference. Because if these spreads go back to anywhere close to what they've been able to get, right? They've been able to get $6, $7, $8. Right now we're looking at $3. If they were able to get $5 on that margin, and again, maybe things will snap back in a year or two. People thinking there's going to be a big glut are wrong, and maybe the Henry Hub prices are actually, maybe we're going to get more drilling, and Henry Hub prices will drop down to $2 per MMBTU. Who knows? There's a number of things that could happen. But if we just say, look at what does that mean if they were at $5? Now all of a sudden, current fair value is around $14. And I think this is what in most of my prior models, these LNG prices, because I think the last time I covered Venture Global on my channel, it was 4, 5, 6 months ago. It's been a bit. These commodity pricing had not fallen to what it was today. Commodity pricing was more in the $4, if you want to do $4 range, it's like roughly $11 to $10. And again, this model is actually much more detailed than what I've done in the past. I got their actual cost of capital, their actual interest rates that they have here. If you look at this, it's $8.75%. And I actually think this might come down over time. And again, coming back to how I have my model here, that could make a material difference. If this interest rate, hypothetically, let's say it dropped a little bit, 8.25%, dropped 0.5% all the way down until they got to about a 7% rate, because they're actually getting the facilities online. They have stable cash flows, 7.75, 7.25, and then 7%. Go for 7% into the future. This also, is going to have an impact on the valuation of the company, and we can see, that's a current intrinsic value of $12.62 per share if we assume long-term margins of $4. If we go back down to, what did I have originally, $2.50, that's not nothing, right? That, I think originally this was around $6 or $5, and that's maybe I made some other change somewhere that also impacted it. But I mean, this incrementally is going to help out their free cash flows year after year after year. And I think that's another thing that, again, my original model that used just their current interest rate they have, their weighted average interest rate on debt, is Is bad. That is an excellent question. Essence of Bitcoin asks, do rate cuts help bring down interest rates? Yes and no. Right. What really matters is going to be, what are sort of longer term interest rates, because that I think is more. I think something like the 10-year treasuries is something more like what a lot of these sorts of bonds are kind of use as their risk-free rate. That's my understanding. And so when the Fed cuts rates, that is not directly impacting the 10 year, it's impacting short-term interest rates. But I think, sooner or later, if short-term interest rates go down and down and down, it historically has had an impact, eventually on, uh, longer term treasury interest rates. And so I think that if I was just going to give a short answer, the short answer is likely yes. So maybe I should just said that instead of giving the full monologue. But that is another thing that could happen, and that's where it was one thing that if we looked at projects that were happening during the zero interest rate, period, some companies were able to do things at unsustainably low interest rates that no other company could really replicate. Sort of like folks who got 3% mortgages, right? The interest rates across the board were just really really low, and that was a big help. If we had a similar situation in the future, if short-term interest rates go down to 2.5 or 2%, and the long end of the curve actually drops down by a couple 100 basis points, and they're able to refinance this debt, that helps significantly, because they may not need to be it helps because if the long-term interest rates get lower, the entire yield curve sort of moves toward that, and Venture Global has the opportunity to refinance at a lower rate, even if they are not more credit worthy, right? Usually, if you want to drop your interest rate, you need to get more credit worthy, and I think that will happen as well. I think Venture Global, as they start to have these facilities come online, and maybe like there's a bit of an interplay here where I model them out as having to borrow more debt because they are trying to expand as fast as possible. They alternatively could sell equity, and then they wouldn't need more debt, but that of course is diluting common shareholders like myself and like probably many of my viewers here, and so hopefully the company is going to, we don't know exactly how they're going to finance things, but I modeled it here as if they're just borrowing debt, a combination of debt and just their cash flows that they are getting from their projects that are already producing LNG. But I do think they're going to be getting more credit worthy, and my point was if they slow down on that expansion, they could probably make the case that they're borrowing less debt, and so their debt to EBITDA gets better quicker, and they could probably lower their interest rate at the VG level over time quicker if they did that. But it would be at the expense of not expanding as fast. And again, they could also accomplish that if they just sold more equity to fund their portion of these projects rather than borrowing debt. They could do this with issuing no new debt, but they would have to issue more equity and sell more VG stock or some preferred equity in VG, which I hope they don't do that. I'm not really a fan of those sorts of things, but it's a possibility. The one thing that I do keep in mind when it comes to those calculations is that management is a very very large holder of VG stock, and so it's not something I've talked about in too much detail since my very very first video on Venture Global, but management owns quite a bit of this company, and so they are aligned with us as common shareholders. I think they have a separate class of stock, but I think it is convertible 1-to-1 into common stock. I don't think it has any anti-dilution provisions, if I recall correctly. What it does, I think it gives them more voting rights, but management is going to make decisions that are not dilutive, because that's going to hurt them disproportionately, because they hold quite a bit of the stock. So that I think is something just to note. Another question from, sorry, I'll try to pronounce your name just so I have it. Anantaraj Waggle 7034. Sorry, I'm sure that was wrong. I apologize. Which company would you prefer in between Next and VG for the next 5 years? And are all the projects of Next 1 to 3 already contracted, as the cash flow they showed last month is guaranteed? So for next decade, for all of, so they have a positive FID on trains 1 through 5. I think overall they've contracted roughly, and don't quote me exactly on this, but I think it's roughly 80% of the volumes of trains 1 through 5. And next decade has, I want to say it's 90, 90 to 95%, somewhere in that vicinity, 90, maybe it's 93% of trains 1 through 3 are under long-term sales and purchase agreement. So those already have the fixed fee in place. And then trains 4 and trains 5, I think, are closer to 75% contracted. Um, so all of that cash flow, I mean, guaranteed is not quite the right word, but as long as next decade executes and there's no force majeure events, um, generally yes, for those contracted volumes, they are uh, they're going to get those cash flows. Um, I will I will certainly do an updated video on next decade that kind of joins in some of this future LNG curve data. That's on my short list of things to do. My two most requested updates have been Venture Global and Next Decade in the past month or so. So I will definitely get the Next Decade probably for my next video because again I can also reuse a fair bit of the research I already did for Venture Global in terms of the LNG market here. But I think and I've done a fair bit of that for myself. I personally hold more Next Decade than Venture Global only because I started buying it 5 years ago, and I've been slowly buying it, for much longer than Venture Global has been a public company. Also, I think Venture Global, when they IPO'd, it was just not at an attractive price, and it's taken some of these downturns to really get down to a price that I think is really really attractive for the company. I think at current prices, I've been buying slowly. I don't have a lot of cash at the moment to be purchasing. I need my cash for other things in my life, but that Venture Global is on my list of companies that I've been acquiring more shares of, as has Next Decade. So, sorry, I know I'm not really answering your question. Which company would I prefer in between Next and a VG? I think Next Decade, I think I would say I prefer Next Decade, and the reason why is because they don't own 100% of any of trains 1 through 5. I think now that they have those all positively FID'd, they do have the potential to expand and to maybe accrue a lot more to their company to expand for train 6, 7, and 8. I think maybe 9 and 10 are a little bit tougher to envision what the economics are going to be, but they do say that they have space for all of those. I think 6 through 8 are going to be the nearer term focus. And I say nearer term meaning next 2 to 3 years. I do think the slowdown in the LNG market is going to be, it's kind of put pressure on all of these folks. But when they're doing what is closer to an expansion rather than a brand new facility build out that they might have to do for any expansions past their existing cleared space. I think trains 6 through 8 are going to have pretty good economics. Better than they've had in the past. They're going to be closer to trains 4 and 5 rather than 1 through 3, and that expansion potential. They're going from, if you look at their cumulative ownership, they only own like 20% of trains 1 through 3, and then was it 40 and 50% of train 4 and train 5 respectively. And so if they can own 100% of train 6, that's more ownership than they had in trains 1 through 3 combined. Just with that one train 6 that they're able to retain 100%. It's almost double what they have in trains 1 through 3 combined. And so that expansion potential, I think, for Next Decade is pretty big. Because my model here for Venture Global, I'm showing you here where the current intrinsic value per share and what the market is roughly pricing in terms of discount rate, and which is another thing we could talk about. Maybe 10% is too high of a discount rate because a lot of these cash flows really are, again, guaranteed is not the right word, but they are under contract, right, for those fixed fees that they have. If I were to maybe use an 8% discount rate instead, that bumps up the share price, the intrinsic value, a fair bit, right? If you just want to discount that a little bit lower. Again, all things that you could quibble about and talk about for yourself. And I don't like using their weighted average cost of capital for determining discount rate. I just, on first principles basis, disagree with that, but that's a separate conversation that most people probably don't care about. But to answer your question, or to get back to answering your question, sorry, I have something in my eye. Venture Global, I've already modeled out here their expansion at their CP2 facility and their Plaquemines facility, and that gets you to, with depending on what your assumptions are, roughly where they're trading at today. So they have to still execute on those in order to reach what I'm modeling as their current intrinsic value per share. I do think the market is assuming that, and there's future expansion potential for Venture Global in terms of CP3 and Delta, but next decade has a clearer line of sight to a bigger sort of a bigger step change in terms of what ownership do they have in terms of LNG export capacity, right? Because train six, trains if they built train 6, 7, and 8 and owned 100% of those, I think just building those 3 trains would be probably just train 6 and train 7 would get them equivalent ownership to what they have in trains 1 through 5 today, because they only own fractions of each of those 5 trains. So I think the expansion potential for next is higher. And so if you ask me which one would I want to own for the next 5 years, I think I have to say next decade, because it's also not exactly trading at a premium. All of these LNG market valuation issues, or I should say LNG commodity pricing issues, they're reflected in next decade's price as well as Venture Global. There's a reason why we saw the company, why we saw next decade drop from, being at the hovering around the $10 per share range down to, $6, and that's because of long-term LNG pricing, at least in my opinion. They don't, to my knowledge, unless I'm forgetting something while I'm live here, they don't have any sort of arbitration going on or any legal proceedings like Venture Global does, but yet their stock is dropping pretty similarly, right? And that's, again, because I think the LNG market is the absolute largest factor that's going into these valuations, because it determines their future profit potential. As the spread between JKM/TTF and Henry Hub compresses and compresses and compresses, like, that is just their future profit compressing. So if that spread gets cut in half, it's still profitable, but their profits are literally cut in half, and that makes a humongous difference in terms of what's the company worth. So, all right, I've been talking for a while, answer some questions, and that's I'm going to try to wrap things up and get off of here, but if you have any last-minute questions or comments, please put them in the chat. Johnny Utah 420 says, you would need 10 years to realize train 8, 5 years is too short term. So yes and no, right? They might be able to FID up to train 8 within the next 5 years. And I think the market would start to give them some credit for that, right? I don't, you're right that, and if you want to actually get, let's say dividends in your pocket from the cash flows that come from train 8, yeah, 5 years is almost certainly too short for that. And you probably do need much closer to 10 years. However, if you're just looking for what is the reaction in the share price, I think you'll see that sooner than 10 years, right? If they were to hypothetically get a positive FID for one train in the next 3 years, 2026, 2027, 2028, if that was train 6, 7, and 8, you'll see the stock react. I assume you'll see the stock react in each of those years. It won't be as much as what they'll be at full operations, but you'll start to see it, at least a good portion of that. And so I think that's just something to keep in mind. You are totally correct in terms of if you want to start seeing in the actual cash flows and get the dividends in your pocket, I assume dividends from train 8, yeah, you're going to need somewhere closer to 10 years for that. So all right. Great discussion here. I appreciate everybody who tuned in. Thanks for coming to my channel and listening. Hopefully you found this useful, helpful. If you have any questions or comments, leave them in the comments on the video, or you can reach out to me on X. I'm just at Dustin's Dollars there. And the spreadsheet is linked in the description. Nobody mentioned they had issues with that. If you have issues, again, comment or send me a message on reach out to me on X. I can, try to troubleshoot. Yeah. Hopefully I don't want to waste anybody's time. Don't see any new comments, so I'm going to wrap it up and hop off. Thank you very much for watching, everyone. Have a good